Welcome back, everyone. We have an exciting episode to get into. In this one, we're going to be going over two different earnings reports, Apple and Amazon's. Now, both of these companies are very meaningful to the market overall. They combined make up trillions of dollars of market cap. So even if you're not invested in them directly, they're still incredibly important. But I happen to be invested in them. And I'm not just invested in them in a market weighting. I'm way overweighted these companies. I've done that intentionally. A lot of people criticize me. They say, Joseph, this is so almost boring. It's too easy. You're doing too easy of investing. You're just investing in really big, profitable companies. Guilty as charged. I invest in companies that are big and profitable and have dominant moats and great business models. And if they're easy, that's even better. I think in investing, we should try to look for easy gains over very complex and difficult gains. So in the passive income portfolio, my main one, I have Apple here. I've owned Apple for a long period of time, and this one has really never given me trouble. Since the day I invested in Apple, the company has just grown and evolved in a very positive way over time. As it's evolved, so have the economics. The gains have come in. I'm now up around $26,000 on this holding, and I continue to be very bullish on the stock. I continue to talk positively about Apple because when I look at Apple, the one thing I'm looking for is that ecosystem. The ecosystem is everything with Apple. All of their big install base of devices and how many applications and products and different services they're able to layer upon all of their device install base. So with Apple, I still remain positive on that because the ecosystem, in my opinion, is still doing really well. But then we have the story fund. This is my more adventurous portfolio. It's a little bit of a different strategy. So far, it has not been working as well, but I'm trying to make this strategy work as well. And what I'm doing here is I'm investing in companies that are a little bit less predictable, but that I think have huge potential for outsized returns. These companies overall, I believe, are less understood by the market with their full economics. So at the very top here, we have Amazon. Amazon has not been an easy holding. Over the past 5 years, this one has been a struggle basically the whole time. It's really been a tough company to invest in over the past 5 years. It's gone way down and it's recovered some, but it's not anywhere close to its all-time highs. And again, both of these companies just reported earnings. Now, as you can see, Amazon is a very large position in this portfolio. Again, way overweighted from where the market is or even where the QQQ is. I have Amazon as 34% of my portfolio, a huge chunk of it because I don't consider Amazon to really be one business as much as a conglomerate of very cool tech companies, very powerful tech companies put together. Now, Amazon just reported their earnings. We have an immediate reaction here from the market. And the market says that the earnings were okay so far. The stock is up 7.45% after hours. Now, when I look at these big jumps or big dips after market, I don't let it inform my opinion of how the earnings went. Because in many cases, it just doesn't make sense to me. I've seen Netflix drop 10% after earnings for reasons unknown to me when they hugely beat expectations, and then within one day, it's back up 10%. So there's many cases where this type of stuff, whether it's up or down, you can get excited about it if it's up, or you can become saddened if it goes down. And I don't think that's the attitude we should have. Instead, we should look at what direction the company is going, the fundamentals, the intrinsic value. How are the cash flows looking in the future? Now, if we ignore just the market action, we can start off with Amazon first. And I'll look at just the basic top and bottom line and the headlines here. CNBC has the headline, Amazon reported sales growth of 11% and issues optimistic guidance. This is the big one right here. Optimistic guidance was crucial. If Amazon came in with very pessimistic guidance, I think the stock would have given up all of its 7% bounce and it would have gone into the negative 5 to 10% down. But they gave both a great quarter, 11% growth above double digit growth with 10%. They came in with 11% growth, and then they gave optimistic guidance on top of that. So we have both of the key things checked off there. Now, if we look at this out of breakdown here, in earnings per share, 65 cents versus 35 cents. The earnings per share you can look at, and again, I could try to be excited about this, but it's not the most important thing in the overall story with Amazon. There's other metrics I look for with how Amazon's evolving over time. I don't think EPS is the most important thing here. The revenue is important. We want to see Amazon continue to grow, and they made $134.4 billion, which is way above expectations. Analysts were expecting $131.5 billion, and they came in with 134. So they earned an extra $3 billion, came in $3 billion above expectations. It's just wild how much revenue this company deals with. Then we have the web services. This is what everybody looks at as well. We have $22.1 billion versus $21.8 billion. A very sizable beat there as well on AWS. That's a very positive thing. And then the advertising. The other thing that we look at here is $10.7 billion versus $10.4. So when I'm looking at Amazon, I've repeated this routinely. The three big things that I look for is the Amazon Prime business, which encompasses retail growth. How is their core business of retail doing? I think it's doing really well. Revenue's growing overall. They're hitting all-time highs in their revenue. $134 billion is way above expectation. So we have the one pillar of the business, which is the Amazon Prime retail business, and I'd wrap in Prime Video with that as well. That's growing like a weed. It's growing at 11% per year. Then we have the second pillar of Amazon, AWS. This is growing as well. 22.1 is above expectations. And then we have the advertising, the third pillar, the third driver of intrinsic value, growing as well. Now, if I want to get a deeper insight into just how fast each of these segments are growing, what I do is I look at the earnings report here, and there's all this information you can get, the top and bottom line of the company. They highlight some good stuff here. Their free cash flow for the quarter was $7.9 billion. Nice of them to have a positive free cash flow quarter. That's nice to look at. But again, let's go ahead and take a look at the three pillars of Amazon: the Prime business, the AWS growth, and the advertising growth. To do this, we'll actually go down towards the bottom here. And it's difficult to find because Amazon's earnings reports are literally, it's like a novel. It's so many different things you can look at. But it's towards the very bottom here. There's a bit of data that I think is the most helpful. This is on page 14, if you have the report open yourself. So what we're looking at here is supplemental financial information and business metrics. And this is what they do. They break down each segment of Amazon, and then they give you the growth rate on a constant currency basis for each segment, which I think is very helpful of them to do that. So we have the online stores. This is first party, which is the lowest margin portion of Amazon. I don't personally care if this grows that much. I think the third party is much more important. But this actually had decent growth, 5% growth year over year from this quarter. That's good. It was slowing down to nothing. A year ago, it was down to 0% growth. It even went negative for a quarter. But now we've resumed growth back to 5%. Next up, we have the physical stores. This is more experimental. I believe they have Whole Foods in this. That grew 7%. Not an intrinsic value driver of Amazon. This is something where it's at best a mediocre business. It offers nothing great for the investor to look at so far. There is potential there if they do some new concepts, but right now, I do not consider this intrinsic value creation or something that's integral to the thesis in Amazon. The third-party seller services is very important. This is where other businesses list items on Amazon, and they put their items in Amazon's warehouse. Amazon charges fees all along the way. They charge storage fees by the amount of volume that you put in the warehouse. So as you're storing it there, Amazon is like a REIT, charging you rental to store the merchandise there. Then as Amazon fulfills and ships and delivers and deals with customer service, everybody loves that 2-day shipping. Amazon charges fees all along the way. So this is a very high margin business. And Amazon only recognizes the revenue of the fees that they charge, not the total revenue of the item being sold. This grew 18% on a constant currency basis. That's really fast growth. 18% growth in third-party seller services. And this also goes against the basic idea that Amazon's this big bad company that competes against their own sellers. They're not really doing that because if you look at it, this is Amazon's first-party sales growing 5%, and then Amazon's third-party sales, the other businesses, growing 18%. So if they're competing against their own sellers, they're not doing a very good job at it. But that's very, very strong growth, 18%. Then we have the subscription services. This is obviously important to Amazon. We have 14% growth there. But then we get to another main pillar of Amazon, the advertising. Advertising grew 22% year over year. Amazon has incredibly targeted ads through their Amazon Prime Video and especially through their Amazon.com. When you go there, they have sponsored listings. In many cases, those sponsored listings are great items. I've bought many of them myself. The sellers there are very incentivized to keep high star ratings, so they're always good with customer support. And it's growing very quickly. 22% ads growth is so fast. That's faster than Google, faster than Meta. It's off of a smaller base, but it's incredibly consistent fast growth over the past 3 quarters. We've gone from 23 to 23 to 22. And I have to imagine that the margins on this advertising revenue is in line, if not better, than Meta's margins as an advertising business because of how targeted these are. So we have pillar 1 up here, the third-party sales and the subscriptions. Then we have pillar 2, the advertising services. Then we get to pillar 3, which is AWS. Now, this is where I thought Amazon was going to run into trouble and really disappoint. A lot of people thought this would come in below 10%, sub 10% growth. And what we have here is 12% growth. Now, you may not think that just 2% is a big difference. That is a meaningful difference when you're looking at the scale and size of AWS. It is over twice the market share of Microsoft's Azure. This is massive, and it's still growing at 12%. Now, we also have other here as well, not core to the business, a very small base. That's their other experimental stuff. In summary, the 3 pillars I'm looking for: the Prime business with all of the third-party sellers and subscription services, the AWS, and the advertising. Those are the 3 pillars, and they are growing fast, they're growing fast, and they're growing fast. We have advertising here, and we have AWS. All the segments I'm looking for in this company continue to grow at a fast rate. Now, I have to believe if all 3 of these segments are growing, that the value of the company is growing. Whatever it was worth a year ago, it's worth more today. The stock price might be different. The stock price trades around based on lots of thesis and thoughts of investors and different opinions, and it trades around on interest rates of the what the general economy is doing. Lots of sentiment drives stock prices. So over the past 5 years, who knows what direction the stock price is going? But at least right now, what I'm seeing with Amazon as a company is the intrinsic value with the main growth drivers moving very, very brisk pace in the right direction. So in terms of my thoughts right now, and I haven't had a ton of time to look into this, I'm going to be diving into the report in more detail, but my initial reaction is I feel good about the earnings. I would have felt good about these earnings if the stock went down 10%. So I'm not letting the stock price inform me of what I should feel, but rather I let the actual earnings report and the cold hard data inform my impression on this. And when I see this, I see a business that's moving. It's moving in the right direction. So that's my thoughts on Amazon. As of right now, I have no intention of selling. I think it's headed in the right direction. I can't wait until the data is plugged into Qualtrim and I can look at all of these metrics, dig down into the stock-based comp and the financial, the free cash flow, all of that fun stuff. So I'll have a more thorough report on Amazon coming up soon. Make sure you subscribe to the channel if you want to see that. But this is my quick reaction on it. Let's go ahead and move on to Apple. All right, now we have Apple pulled up here, the stock price, and the immediate reaction from the market after they released their earnings. Right now it's down 1.8%. Now, I've owned Apple since the tail end of 2017, so I've owned it for over 5 years. I've kept track of the stock, and I've looked at all of the earnings reports, and this is completely normal. Having after hours it trade down a couple percentage or go up a couple percentage, that is par for the course. So nothing surprising there, nothing out of the ordinary. Let's go ahead and take a look at what the headline is from CNBC. Apple beats soft expectations driven by 8% service growth. So they beat their expectations. That was a prediction, a very easy one that I made. Apple typically beats their earnings per share and their revenue. So they beat on the top line, they beat on the bottom line, they beat EPS and revenue. iPhone revenue just came in underneath expectations. Mac revenue came in just above it. Other products came in sort of in line with expectations. Service revenues where they had very strong beat there, 21.2 billion versus 20.76. And then gross margins were 44.5 versus 44.2. Apple's gross margins are going up because they're less dependent on revenue growth right now than they are on margins. And this is something that I brought up many times. A lot of people are going to look at this earnings report, and I already know what they're going to say. This is what you're going to see on Twitter and on Reddit and everywhere. You're going to see this. The revenue went down and Apple's at a 30 PE ratio. That doesn't make sense. Why would anybody pay 34 PE for a company that has declining revenue? So let me address that concern first. Apple's revenue has slowed down a little bit, but that's going to be a temporary thing. There's other times throughout Apple's history that their revenue has declined. In fact, I think the most recent time was in 2016. And if you would have sold Apple in 2016, you would have missed one of the best companies in the market that went up 5 times. So 2016 was precisely when Warren Buffett was buying into the company, and that is precisely when they had a year-over-year revenue decline. Now, in terms of what Apple is dependent on, I've shown this chart a time or two on the channel, and we can look right here at the revenue of Apple. Apple's revenue is in different segments that we just looked at there. If we cross out some of the smaller segments here, we get to the more important ones. And here we see that they have wearables, the Apple Watch and the AirPods. We have the iPad. We have the iPhone. When we take all of those away, we're left with services. Service growth is enormous. This is where they're growing the fastest, and this is the highest margin portion of their business. So we see a strong growth line quarter by quarter with services, and that's where they're raising their gross margins. That is carrying Apple stock right now. And they note that right here, that the service growth by 8% is really what helped beat the expectations. So even if the revenue stays flat or just grows along with GDP, Apple will keep growing the service portion of their business, which is a very economically important portion of their business. So in terms of what I see with this earnings report, the other thing that I want to look for is the install base of Apple. I want to see that they're at least maintaining and increasing their install base. If Apple is increasing their install base, the company's in great shape. It is in 100% great shape. If the install base is going down, that's a little bit of a red flag. That would be a slightly concerning. But overall, I believe that the install base will at least be maintaining, if not increasing. We'll have to listen to the earnings call to find out. My initial reaction with Apple is unexpectedly, it's just business as usual. This stock is just going along, right along with expectations, business as usual. I am not concerned about this revenue slowdown. Apple has had that in the past. They'll have it again in the future. That's what revenue does with companies like this. You can see some periods of time back here, 2017, where the revenue gets a little flat. It's a little flat right now. It'll speed back up. They'll come out with new products. They'll have new subscriptions and services. They have the ecosystem. In fact, there was just news released, I believe a day ago, that Apple has $10 billion of assets in their Apple savings account. $10 billion. And they did that just by the power of their ecosystem. They didn't have to pay for massive advertising and huge customer cost of acquisition. So when I look at Apple so far, again, I'll have to look at this in more detail and subscribe to the channel if you want a more detailed look at it. But my initial reaction right now is I feel completely fine holding this company. Nothing that I've seen so far gives me cause of concern. That's all for now. I hope you enjoyed this quick little update. I'll have more to come, so make sure you're following the channel, and I'll see you in the next one.